Inflation is a constant in our capital system. As such, the cost of the practical necessities will probably continue to increase over time. In the event you don't earn, inherit, or win a fortune, you will necessarily need to set aside and invest a portion of your capital to build a pool of cash and stream of income to meet your future needs. The major risk for the short-term investor is a capital loss. The major risk for the long-term investor is inflation and insufficient capital growth. Of the myriad asset classes available for investment, most of your investment decisions will be centered on the allocation of your investment capital into the three primary asset classes of stocks, bonds, and cash. Bonds provide for a specific rate of return over a specified period and a return of investment principal upon maturity. With the exception of a period of declining interest rates, the potential for capital appreciation is minimal. The apparent investment risks for bonds are interest rate fluctuations and credit risk. The less apparent risk for bonds is the long-term loss of purchasing power due to inflation. Stocks do not provide for a specific rate of return over a specific period, nor for a return of investment principal. Theoretically, stocks have unlimited potential for capital appreciation, but they also have a bottom. They can go to zero and become worthless. The obvious risk for stocks is short-term volatility or price fluctuation. Last and most important, stocks are the only investment vehicles that offer the potential for real total return. Capital gains plus dividends plus dividend growth. No one has tomorrow's newspaper, so the future is uncertain. What we do have is historical data which may or may not be applicable to today's economic environment. We know, however, that the markets are a discounting mechanism that takes both past history and current conditions into consideration in an attempt to discern the future. Although the review of various rolling holding periods indicates that, in the overwhelming majority of instances, stocks significantly outperform bonds on a nominal and after-inflation basis, stocks can and have suffered significant losses on a calendar year basis. In short, there is no free lunch. When you put your money to work in the financial markets, it will be exposed to risk. However, risk, when properly understood, can be used to your advantage. The difference between success and failure in the stock market ultimately comes down to three things: knowledge, strategy, and tactics. When you understand the differences between stocks and bonds, the advantages and disadvantages, the risks and rewards, that is knowledge. With knowledge, you can devise a plan of attack, which is a strategy. Confident in your knowledge and with a proven strategy at the ready, you are prepared to initiate the procedures to implement your strategy. Those are tactics.